Hello, everyone. My name is John Howe-Wemett. I'm the financial planner here at Generation Capital Management, and this is another installment of John's Top Tips. Today, I would like to talk to you a little bit about IRA contributions and how they might be able to help you with your taxes. When you're preparing your taxes, it's really important to understand how an IRA contribution might be able to help you to keep more money in your pocket. So let's dive right in. Now, IRA contributions can be made right up until the tax filing deadline for that tax year. So when you're getting ready to do your taxes for the previous year in March or April, that's when you're going to want to make sure that you're considering an IRA contribution depending on what your situation is. Now, the way that we should be conceptualizing IRA contributions is that it's essentially a way for us to move money from one pocket in our own pants to another pocket in our own pants, keep more money overall in our possession instead of giving more of it to the government. The IRA contribution is a really nice technique for doing this. Now, there are two different types of IRAs. There's a traditional IRA and a Roth IRA. Those are the two main categories of IRAs, at least. Now, while a Roth IRA can be a good vehicle for saving overall, that's kind of outside of the scope of what we're talking about today. Roth IRA contributions won't help you when it comes to your taxes because those contributions are made after tax. Now, focusing on a traditional IRA contribution, it might be a good way for you to increase your tax refund. And the reason for that is that the contributions are made on a pre-tax basis, which means that the IRA contributions are a dollar for dollar reduction of your taxable income. We also call those above the line deductions. Now, it is important to note that not all IRA contributions will lower your tax liability. Like I said before, those Roth IRA contributions aren't going to lower your tax liability. And if your income is too high, if it's above the IRS limits, and you make a traditional IRA contribution, you can still make that contribution, but it won't be deductible. So you won't be able to lower your taxable income for making that contribution. So just keep that in mind as you're going through and taking a look at whether these contributions are going to help you out. So that's all great, but how do you actually decide if an IRA contribution is right for you? Well, essentially what we need to know is if we have additional cash in surplus above our emergency fund. So are we sitting on some cash in a bank account or in a savings account that's above and beyond the amount that we need for our emergency fund? If so, might want to go ahead and take advantage of moving some of that money from our bank account or a different account that is essentially a non-retirement account and put it to work in our IRA, give us that reduction of our taxable income. Of course, that means that we have to know what our monthly expenses are so that we can figure out how many months worth of expenses we have to cover in our emergency fund. So that means going back to our spending, analyzing what we spent over the past year, and then figuring out what that breaks down to on a monthly basis, just to make sure that this IRA contribution isn't going to get us into trouble with our emergency fund in the event that we need an emergency fund, because we need to remember that even though we keep that money, the IRA is still ours. We can't access it until we're after age 59 and a half, except for very special circumstances. If you have any questions, please feel free to reach out to me. My email address is jhow@gencapmgmt.com, or you can visit our website, www.gencapmgmt.com. We have tons of resources there. But for now, that was another episode of John's Top Tips. Thanks so much and take care.